So can you retire early if you only do options on SPY? Is there a strategy that you can use long term that will give you monthly income as well as not destroy your portfolio? These are kind of questions that were brought up in a previous video where I showed you what an at the money wheel would look like on SPY. And that did get a lot of views and a lot of interest, so I thought I'd follow that up by testing some different strategies that were discussed in the comments. And I see 73% of you are not subscribed, so go ahead and hit that subscribe button if you want more content like this. But let's go ahead and talk about the 3 different strategies I was looking at for this video. And I think the results actually speak for themselves, and that the answer is yes, there's some really good strategies you can do with only SPY that will generate monthly income for you while not destroying your portfolio. So in this video, I'm going to explain those 3 methods that I tested, and then I'm also going to show the results of what happens if you were to withdraw 100% of the income, 50% of the income, 25%, or if you were just to reinvest it all because you don't need the income now, but you want to test these strategies and grow for the future when you might be using these to generate that monthly income. So first off, I like selling puts at like 30 delta, so I wanted to see what would happen if instead of doing the at-the-money puts and at-the-money calls, what happens if you just sold 30 delta puts and 30 delta calls when you get assigned, to see how that turns out. So what I did is I went back into Thinkorswim and did the whole on-demand backtesting thing. And for this version, what I was looking at doing was going the end of the month and just looking at the delta. It's pretty quick to find, 30 delta. And that would be the one that I would sell. And then if we got put the shares on the call side, we do the same thing. We'd look for 30 delta and sell those cover calls. So that if the stock did go up, we would accumulate some profits from the shares going up instead of being at the money where you're just locking in huge losses if SPY goes up. So I was curious how that would play out. And that's the first one I tested. And the result is similar to what we had in the last one. Your portfolio did decline overall, and that's because that March dip, even at 30 delta call when you got put the shares, you're still going to lose a lot of money per contract, 5,100, and it's just a huge hit right at the beginning of this test. And that's why I love this little time period we did, because if any of these strategies are going to fail, it's good because of a huge dip like we had back in 2020 of March. So that's why I love that this starts there, because it's going to say if this is going to fail, it'll fail here. But you can see overall it did go back up a little bit, and that's because in other points where you got assigned shares, you did make a profit from selling the 30 delta call instead of an at-the-money call, whereas doing at-the-money, this was still a loss. And I think this one was actually a gain last time, but it's more here because we're selling a little higher call. So nothing too interesting about this other than the income you generate is less because the puts that you were selling were further out of the money than doing at the money. And same thing with the calls. The calls you're selling, you get less income, and you're kind of banking on the shares getting your portfolio up. But over the course of this 2 years, I think it's still kind of a failure if you're taking out all the income. Now, if you're turning around and you are putting in some of that income back into your portfolio, you can see that quickly changes that. On this one, let me just look at it real quick. On this one, I'm saying you're taking out 25% of the income you make and then put 75% back in. And by putting that income back in, you can see we did maintain our portfolio net account value over the course of those 2 years. But again, our income for those 2 years was only 15,900. So like, can you live off 7,000 a year or 8,000 a year? Maybe not, unless you go to a really low cost of area of living. If we go over to like a 500K portfolio, your income gets doubled, but it's still only 15,000. If you live off 30K a year, if so, then if you had $1 million, using the 30 delta calls and puts would probably work for you. We still see that the contracts that we could sell over time still decreases, and that's because SPY continued going up, so we could afford to do less as long as we try to stay cash secure puts. The next strategy I want to test out was what happens if you sell at-the-money puts, similar to the first video, but instead of selling at-the-money calls or 30 delta calls, what if you sell calls at your assigned price? And the results were a lot better. So in this process here, we did get in the call side, I think 3 times throughout this testing period. And the main thing to point out on this guy is that when you are assigned the shares and you're selling calls at your assigned price, if SPY dips drastically below when you were put the shares, your income is going to drastically reduce. So if you're really relying on this income, like there could be periods here where you're eating ramen noodles for a couple months. So that's what happened during that March dip. We got assigned at what is that? Let me scroll back over here. We got assigned at 324, so we continue selling calls at 324 until SPY finishes in the money, so the shares get called away. And during this time here, you can see that the income drastically reduced because we're just waiting to preserve our portfolio value. Now, I only fixed this column for this strategy on the 250K version here, but you can see that our portfolio does dip as we're assigning the calls and we're waiting for it to come back up. But once it does go in the money and that call finishes in the money, like our portfolio is back at 250K. I don't know why when I first saw this happen, and it was like at the end of 2 years, our portfolio is still at 250K. Like at first glance, I was like, whoa, this can't be right, but it is. We finish with the call finishing in the money. So the shares, since we never sold below our assigned price, we don't gain value from them, we don't lose value from them. So our account value would stay the same if we're taking out all the realized income from selling the calls and puts. So like that makes sense. And over the course of 2 years, the portfolio's finished right where it started, even though we did have like a 40% dip while we were holding through this big downtrend here. Total income, $67,000 for 2 years. Like, that turned out pretty good, I'm not gonna lie. So the basis of this is that overall the market eventually will go up. Just will you have enough patience to sit through these low income months for it to happen? So that's kind of where the question mark would be, is could you weather 4, 6 month, 2 year even? Like what if we get a long-term downtrend of lower income so that you preserve your account balance? That's where the question mark comes up with the strategy. But the results show that, yeah, you can generate 33K a year off a 250K portfolio and basically maintain your portfolio value if you're patient enough and you don't panic sell the shares or anything like that. The 500K version, again, you double your income, maybe a little bit more because of compounding growth. Actually, I don't even think there's compounding growth in this one, but like just about double the income. There's a couple of times where you might be able to sell one more contract, whereas the 250K might sell one less. So that's why there's a little bit more than times 2. And then again, the million should be about times 2 this, and the difference is where like this might not drop one where this drops one contract. Now if we go to the what if you invest it back in and you don't take the whole thing out. In this example, we're only taking out 25% of the income and we're putting 75% back into the portfolio. And you can see that, again, just like every other time that we do this, since we're taking less income out, we're drastically reducing our income, or our portfolio is going up as a result, and it's getting the compounded growth going forward. If you only take out 25% of the income, after 2 years, you've made $20,000. If you take out, if you take out 25% off a 500K portfolio, you're making 20K a year. You might be able to get by on that, but your portfolio is growing pretty nicely. And then again, on the $1 million portfolio, you're making about 40K per year, which I think I could live off of that pretty nicely. But at the same time, the portfolio grew almost 25% as a result of reinvesting 75%. And I did the other percentages as well, but we'll get to that at the end when we look at them all and compare the strategies together. Next up, we had the no assignment strategy. So what this guy is doing is this just selling puts at the money, and then on the date of expiration, we go ahead and we roll that position if it's going to finish in the money. So I'm going to look at a couple of rows here so you can see how I got this tracking here. So the first instance here, we sold the 321.50 put for 418. It finished out of the money, so we don't need to roll. So we just collected that income, and that's awesome. The next position, we sold the 324 strike for 486, but on the date of expiration, SPY was actually below our strike price. So we would have to buy to close that position and put the roll on. Now to close this position, it cost me $3,400 to close each contract. That's a loss of $29.14 per contract. Now the good thing about the roll is that you're rolling for a credit. So although this cost me $34 to close, selling the next month out, I was able to collect $35.40. So I'm actually collecting about $140 profit per contract, even though I'm realizing a loss now. If this guy expires out of the money, I make all that back. Now, in this instance, it did not finish out of the money. In fact, it was in the money. So we had to buy to close that position before close. And then on that same day, so on this example, sorry, we had to buy these for $64 each to close them. So now we're at an even bigger loss. So more realized losses. But again, we're rolling it out, collecting a credit. And eventually, if SPY eventually gets back up to 324, we'll be out of all this, and we will make profit overall, is the idea behind this. So as long as you can roll indefinitely for a credit, that's the theory behind will this work or not. Eventually, you can see that we do finally get a put that closes in the money, or sorry, out of the money. So we no longer have to roll. Actually, I think it's this guy here. This is the one that we actually finished out of the money. So at this point, when this guy finishes out of the money, we made $2,000 per contract. And what happens over here is like your total income column just looks berserk. And it's kind of tough to compare how this one goes with the other ones because your income is going to wildly swing. I mean, look at this, negative 20K, negative 20K, plus 23K, but overall, that's still a 20K loss between all that. So how do you determine how much income you're pulling out per month? And that's one, in this example, I feel like it's comparing apples to oranges compared to the other strategies. Like this one, you just have to kind of set an income that you want to have. So if you're trying to generate $5,000 a month, that's a pretty drastic number, and that's going to hurt your portfolio overall. If we change this to 0, just to look at what happens to the portfolio, saying we take nothing out, you can see that this will generate a net benefit to your portfolio, 335, and we start with 250. So like this strategy did work out because you're always rolling for credit, and eventually, if your last one expires out of the money, like you collected back all those losses and then some because you're always rolling for a credit. Now, let's go ahead and go to the review page here. I think this was a pretty nice setup here. Now, how this is looking at is this is what happens if you withdraw all the income for these different strategies, 50% of the income, 25%, or if you reinvest it all. So I wanted to do all of these because we're all at different points in our lives, so we might not need the income, such as me. I'd probably be reinvesting everything, so I want to see what happened if I just kept letting that snowball forever. Or maybe if I wanted to change it to 25% and put 75% back in, do we still get growth overall as well as income? And you can quickly see like how these work out. Let me talk about the no assignment strategy. For this one, since I have to dictate what income I'm taking per month, I took the average of these two and then divided by 24 to get the monthly income. So that's what this is. So this guy is showing the monthly income for the no assignment strategy, just so that we can compare it, even though it's comparing apples to oranges. Like it just kind of shows you how the portfolio grew or shrunk over time while getting a similar income to what the others were doing that we found out. What's nice to see is that, like in most of these, if you put 50% of your income back in, your portfolio is staying about where it was. So this is just free income. But you can see, like, with a 250K account, if you're only taking half out, you're only getting about 15 to 16,000 per month, regardless of which strategy you use here. If you take 25% out, your portfolio is going to grow over time. But again, your income is just going down drastically. And it's just a quick way to see all that. All right, so now look at the 500K Again, you get similar numbers, just times 2, basically. There's a little bit more compounding growth and more income because you have a larger account to start with. But overall, like, they tend to follow like the same numbers here, just times 2. And then when you go to the million, similar thing. And again, down here, these are the monthly incomes for the no assignment strategy based off the average of these two. So that's what was being used for these. Now, something I found that was interesting was like the no assignment strategy. If your income required is 1% of your portfolio, that's about the sweet spot for where your portfolio would stay at about the same net value overall. So that's something to think about. If you only need $2,500 a month, you only need a $250K account to support that. If you need $5,000 a month, a $500K account would support that if the strategy was to hold true overall for the no assignment strategy. Now, another thing that you can think about is the no assignment strategy. Even though like we test this with cash secured puts, if you have this much money, you have portfolio margin available to you. You can take your cash balance, invest it in some sort of dividend stock, or even like QILD, whatever you like suits your boat, whatever floats your boat, and you can collect a dividend on top of collecting all this no assignment income from selling puts, because you're using the shares that you buy as collateral. So you're collecting income from the dividends while doing this, and like that's just like a whole other realm of possibilities for you to think about, because you don't need the cash in your account to secure the positions. If you have portfolio margin, you're using the positions that you have, which could be safer dividend stocks that pay you income that can be used to secure these positions as you roll it. And just the possibilities of what that can lead to is just awesome. Like, really, I get excited about thinking about that. So overall, I think we've proven that there are different strategies you can use on SPY that will generate monthly income while giving you opportunity for growth, depending on how much income you're actually pulling out every month. So figure out what you need, and any one of these strategies, I think, works. So it's just a matter of figuring out what suits you personally. I like the no assignment strategy. So I have my my cash, I moved into like a bunch of income funds, basically the quadfecta portfolio. And I could potentially just start the no assignment strategy on my current account size and use those stocks as collateral for that to generate income similar to like this level here. And that's pretty exciting. Let me know what you guys think. I think this video only exists because you guys left comments and started a conversation. So leave a comment. Let me know what you think. Are you going to try one of these strategies? Is there another one that you think would be better than these ones that I just tested? And thanks for watching, guys.